the collapse, right? Silicon Valley Bank. Um, Basically, in a nutshell, if you Google it, there's a whole bunch of information you have about it. I'm trying to put it all quickly, right? Quick and easy because I don't have a lot of time. I got a lot of things to do, so I want to put it to you quick so you can understand it, apply it, and maybe give you some ideas on what you can do for your investing journey, right? So basically, banks have money. They hold a certain amount of money in the bank, and then they can use the money that you deposited, portions of it, to go invest and do other things, make money. Well, this bank tried to do that. They were putting out in treasury bonds. Um, I'll give you a quick number example. I'm just coming up with this off the top of my head, right? Fly. So let's say most treasury bonds give you like 1%, right? So let's say you bought one 10-year bonds or something like that. You said, hey, for 10 years, put this money in, you're going to make 1% on it. Almost like guaranteed, right? Because it basically comes from the government. They're like, hey, we're going to invest this money. We'll give you a percentage of it. There you go. Um, this happened maybe around the COVID time, something like that. This is my surmising, right? I haven't looked at the deep details of this situation, but I'm giving you a quick example so you can understand it, so that you can just understand how this works. Because all the details don't even really matter. What matters is that you get the concept so you know what to do for yourself for investing for the future, right? So think about this, or what you may get an idea of what to invest for the future. Because all this is my opinion. You can do whatever the heck you want. But anyways, here it goes. Let's say the treasury bond you buy it, you're getting 1% on gain on that, right? Over time, the Fed's been increasing the interest rate, right? So let's say theoretically they increase the interest rate to 10%. Well, if someone buys a bond and it's a 10% bond rather than a 1% bond, what are you going to gain? 10%. So if you had, any amount of money in, 1% of that money, would you like to get that over a time period? Or would you like to get 10% of the money that you put in over a time period? 10% would be better. So basically what happened, move forward in time, right? The bank's looking to make money on these bonds because they're safe. COVID's happening, war in Ukraine's happening, other things are happening. They don't want to lose a lot of money. So they say, what's the safest way we can put it in? Buy stuff from the government because the government's going to back it, almost guaranteed. Boom, we got it. So in time, the Fed raised the interest rates. When they raise the interest rates, those bonds are now worth less, because why would you pay money to buy something to get 1% when you can buy the new latest and greatest they just put out and you're going to get 10%? You'd be like, hold up, why would I want to miss out on that 10% and get 1% when I can get 10? So then they say, hey, guess what? These bonds are worth nothing. They're like 1% bonds. I know we're going to make money on them, but like, let's get rid of these things, which were worthless. That's why they sold them for a loss. And then buy these other bonds that are worth 10% because they're going to give us a lot more money. We'll make back what we lost and some. So basically, that's what happened in a nutshell. They decided to sell the bonds to get new ones, but when they sold for a loss, right? So when the public information came out, they said, hey, they lost billions of dollars in an investment and they didn't make any money on it. It's like, okay, well, maybe they didn't now, but they were going to do it in the future. People, maybe they don't understand everything about how banking works, get freaked out. They're like, oh no, that bank lost billions? Oh my gosh, I need to get all my money out. So basically, since banks only have to have a portion, a small percentage, I would think it's around 10% of deposits on hand, is cash to give to all the people that deposited. If everybody goes to the bank and pulls out their money at once, guess what the banks don't have? Enough money. This is what caused a collapse. Too many people taking money out, too little time, too many people all at once, all want their money. And the bank's like, well, most of your money, we don't have it. We invested it. It's not even ours right now because we put it in something and we got to sell those investments to get it back. And we don't want to sell them right now because we want to make money on them in the future. So, you're taking more money than what we have on hand, and then blah, 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 blah. Things happen, right? Blows up. It's in the news. It's all over the place, everywhere. Here's what you think about, right? First of all, in this example, the FDIC, who insures your deposits up to $250,000, has decided, hey, we're not only going to make sure everyone who's insured up to $250,000 gets their money back that they deposited, but any people who had lots and lots and lots of money, we're going to make sure you get back every dime, right? So how do you think they're going to do that? I mean, again, I'm not getting into nitty-gritty details. We're just thinking of, oh, hold up, my phone's ringing. We're not thinking of the nitty-gritty. Oh, and kid toys are on the bed. Yes, because I do these things on the fly. Anyways, where was I at? I was saying, yes, where are they going to get the money? Probably from taxpayers, right? They're going to get it from somewhere because the government's paying it. The government, where they make money, they make money through taxes. So that's probably how it'll get paid. Then you think about this for the future, right? You're like, so these banks are going to get bailed out. They're not going to fail. Oh, and then there's another bank. Let's see. I wrote it down. First Republic Bank. Yeah, they were starting to go bad because of the ripple down effect. Some people not scared of. Some people get fearful of this bank that failed and is going to get backed up. And they're like, oh no, we don't like this bank either. So bankers are trying to figure out, how do we make the consumers have confidence to still put their money in our banks? Well, the way they're going to do that is by they came together. So here's the example we're talking about, right? The main meat of the story. I don't even want to go into a long story. Bank of America, JP Morgan, Goldman Sachs, Wells Fargo, they all get together, right? They put together some money, put it together and say, hey, we're going to save this other bank so they don't fail. So now we got banks who already borrowed money from their people that deposited, who use it to make investments, are now having another bank that's going to fail, and they're going to take their money and pool it together so they all don't have to pay a lot, and they're going to put it together to save this other bank who's failing because people are failing the banking systems. This is crazy. So what's crazy here is all of this, I think, is going to push, my opinion, is going to push a lot of people to go into unregulated financial systems, right? So like crypto was booming a couple years ago. Then over the last 6 months, year, sometime, I don't know, whatever, it's been going down, right? People are like, oh no, we don't have confidence in cryptos. There's too many scams, too many this, too many that. It's not going to work. Oh my gosh, I don't want to be in crypto. We're going to sell my crypto. We lost everything we had in there. Now, I predict in the future, people are going to say, wow, we thought we were safe with the banks. We were trusting all that mess. Now we're going to go back to crypto. That's just what I predict is going to happen, but we'll see. If you want to look more information about how the banks do their thing, it's called fractional reserve banking. It shows that they don't have to have everything on hand. But here's what I will look at, right? Because I mean, I'm a surveyor of all things to invest to make money, right? So I think this is opportunity. We never know when another bank's going to collapse or when something's going to happen that's going to ripple down throughout the economy. So we say, how can we maybe benefit from this? Well, I looked up some things about some stocks, right? So I look into dividend investing because I want to build a portfolio that pays cash income to me to pay my bills, right? Pay for stuff in life. That's my goal. So I started looking at companies that pay dividends. I started looking at banks in particular because right now, almost every bank is down. Hold on, we're just going to go here first. So we go like, okay, this is Goldman Sachs over the last month. Boom, they're up around 360 something. Now they're down to like 300. If we were to look for another bank, let's look at BAC, that's Bank of America, because I want to talk about the ones that bailed out this other bank. So look at Bank of America. Right now, if you look at them for the last month in their chart, they were, maybe I should have these up so it wouldn't take as much time. But you'll get the concept of what I'm saying, right? If you looked all this stuff up, because my internet is not interneting, it's down a lot. Okay, let's see. Last month, boom, it was up in the 30, 35. It's down to like 27, right? If you look at Wells, Fargo, let's see where they're at. Okay, for the last month, they were probably up, and now they're probably down because of this whole debacle that is happening. So I just look at this opportunity, right? Right now, these banks are still doing the exact same thing they were doing before this collapse happened, right? Now, the chances, I think, of all the banks collapsing at once is probably pretty low. Like, every bank is not going to collapse at once because a lot of people need their money in the bank. That's how we live in a financial world. We use cards and we swipe. We need savings accounts and checking accounts and other things like that, and that's how we make things work in the world, right? So every bank's stock probably going to go down. But right now, they're down very, very quickly in a very, very short period of time, not because their business model or what they're doing is bad, but because of some event that happened in the world. This is prime opportunity. So they're down now, and it's like, man, maybe now would be a good time to buy. Because in the future, I don't see banking really going away. Like, it may change, it may develop, other things may happen, but many of these banks have been around hundreds of years. They're not going anywhere, in my opinion, in the near future. So I looked at one other thing, right, about the banks, because I looked this up actually back during COVID, but I want to show you some examples of it. Back during 2020, when COVID was happening, we can look at Bank of America, for example. Let's go back to the last time they did not raise a dividend. So if we go all the way back to 2010, that's a good time, about 10 years ago, 10, 12 years, 13 years ago, right? They're paying about a penny per share in their dividend yield, right? As you move forward, they went up to 5 cents, they went to 7 cents, 12 cents, 15 cents, 18 cents, 21 cents, 22 cents right now, right? So even during COVID, during a time when the world was going to hell in a handbag, you still see they were still paying a dividend, and they continue to increase their dividends since then, all the way up to now, right? And if we look back going further, let's see, back to 08. I'd have to look at the history and see what happened here in 08. I'm surmising they probably had a share split or something of that nature that then caused the price that they're paying per dividend to go down. That's a whole nother topic we'll talk about another day. But basically, since 2009, the 08 housing market crash, when that was going on, they started at a number and they've been paying more ever since then, every cycle that they pay for their dividends, right? So that means if I had, let's say I had 1,000 shares back in 09, 1,000 would move this decimal place over, what, 3 places? 1, 2, 3. So I'd be getting, I can't even do the math, $10 or $100. I don't know. Someone check the math. Either way, whatever I was getting back then, if I had 1,000 shares, 0.01 times 1,000, that's what it would be, right? Then if I kept those same shares, didn't touch them, didn't move them, didn't do anything with them, guess what every cycle they would continue doing? They continue paying me all the way up to now, where instead of getting a penny, I'm getting 22 times whatever I was earning before in dividends, right? I can't do the math because I'm trying to think of too many things at once, doing a video. So either way, hopefully this is helping you see a big picture here, right? So we're going to look at Goldman Sachs. Same thing. We're looking at Goldman Sachs going back to at least this 2008 time period. You got, okay, they're in the 30 cents per share. Looks like the special dividend there. And 35 cents a share, 50 cents, 60, 65, 70, 75, 80, $1.25, $2, $2.50. They're up to $2.50 now, all right? throughout COVID. COVID was a huge, way worse crash than what's happening right now with the banking system. Did they decrease or stop paying a dividend? No, they did not. You see, it keeps going, and guess what they did? They started paying even more. All right, we're gonna close this out because I guess my browser, it's going pretty slow. Chase, let's look at Chase, the same thing. Okay, we're gonna go back. Let's see, where are we at? 2008, 35 cents, 20 cents, 35, 40, 45, 60, 65. I feel like I'm at an auction. 65, 70, 80, we got up until $1. Boom! Chase, did they stop paying a dividend? Or did they start paying less even when COVID happened? Even back from 08 when the market crash happened. Let's see, 08 market crash. Okay, maybe they paid a little bit less. But you gave it, let's see, 1-2 years, they're already paying the same as what they were paying before. If you look at that change, right? So a concept I try to tell people, like when you invest in something, think about it, 5-year time period. Give yourself at least 5 years to think about if it's gonna be a good investment, right? If you see a good opportunity and you get into it, hold it for at least 5 years. Okay, statistically, there's some numbers, there's some data, there's some information out there. It's all in my investing course that tells you this. Usually a pretty good idea, 5 years or more to hold on to things. Yeah, I'm not gonna go more into that because I'm trying to make this short and it's already getting long. But you can see the concept here, right? These stocks right now are artificially down because of fear, not greed, right? Now, in my opinion, would be a great time if you had some funds to invest in a multitude of banks maybe and say, hey, a lot of these banks pay a dividend. If I invest in the shares of this bank, they're going to pay me every cycle that they pay just to hold those shares. Well, right now, those shares are super low. So really, you're getting this, Chase, you're getting this dollar per share at a discount, right? Because if we look at Chase, let's see, I'm going to pull it up over here. If we look at Chase's price point and we were calculating the math of their percentage dividend yield that they give you, if it was at, let's say, $100 per share before, and you're getting $1, and now it's at $50 per share, and you're getting $1 for your dividend. If you put in $100 before, you only got one share to give you $1. But now, if you put in $100, you get 2 shares and get $2. So you literally can increase your cash flow right now while they're low, rather than buying them when they were high. So see here with Chase, they were at $143 earlier this month in March. That was a high in the last month. Now they're down to $125. And guess what their dividend is? The same thing that they had before. I don't know about you, but when I look at things like this, I'm like, this is just prime opportunity. Again, this is my opinion. If you want to put money in crypto, I don't know, that could be a good idea. That, again, is my opinion. Figure out what you want to do. But this is just some ideas, quick snippet I had because all the kids are taking a nap. And I said, I'm going to do a video. I'm going to put it up. Hopefully somebody learned something from it. I hope it helped you. If you do, like, subscribe, do all that fun stuff you do. And we'll go from there. Peace out. Have a good day.